Welcome to Section 5 of the ASC 225 Income Statement Training Series. In this section, we turn our attention to income tax expense, how it is presented on the income statement, what disclosures are required in the notes, and how tax effects are allocated across the different components of income and equity. This is a critical area where presentation errors can significantly distort a reader's understanding of financial performance. By the end of this section, you will be able to identify the two components of income tax expense, current and deferred, and understand how they are presented on the face of the income statement. You will be able to describe the note disclosures required under a SC 740-1059, including the effective tax rate reconciliation. You will also understand the purpose of intraperiod tax allocation, why the residual method is used for continuing operations, and how tax effects are presented for OCI, discontinued operations, and equity items. Before we look at how income tax expense appears on the income statement, it helps to understand what is inside that number. Income tax expense has two parts. Current tax expense is the amount of tax actually owed to taxing authorities for the current period based on taxable income. Deferred tax expense reflects the change in deferred tax assets and liabilities, timing differences between when income is recognized for financial reporting versus when it is taxed. The full measurement rules live in a SC 740. Here, our focus is how these components are displayed and disclosed. Regardless of how complex the underlying tax calculation is, the income statement itself presents income tax as a single line, labeled Income Tax Expense Benefit. This line sits immediately after income from continuing operations before tax. The parenthetical word benefit signals that the amount can be negative, a tax benefit rather than an expense. The breakdown between current tax expense and deferred tax expense does not appear on the face of the statement. That detail is reserved for the notes, which keeps the income statement readable while still providing full transparency. A SC 740-1059 requires companies to disclose in the notes what makes up income tax expense. Specifically, entities must separately present the current portion and the deferred portion of tax expense, and further break those out by federal, state, and foreign jurisdictions. The deferred portion should be explained by the major categories of temporary differences driving it: depreciation timing, loss carryforwards, stock compensation, and so on. Changes in valuation allowances on deferred tax assets must also be disclosed. These note disclosures are where readers go to understand the quality and sustainability of a company's tax position. The effective tax rate, income tax expense divided by income before taxes, is one of the most scrutinized metrics in financial reporting. For public companies, US GAAP requires a reconciliation in the notes that walks from the statutory federal rate to the actual ETR. Every item that causes the two to differ must be explained. Permanent differences like non-deductible meals, tax credits, state taxes, discrete items, and changes in uncertain tax positions all show up here. This reconciliation is how investors and analysts assess whether a company's tax rate is sustainable or driven by one-time factors. An ETR that looks unusually low or high demands documentation. Here is the problem intraperiod tax allocation solves. Imagine a company with a large gain in other comprehensive income and a small operating loss. If all tax expense were loaded onto continuing operations, the operating results would look far worse than they actually are on an after-tax basis. A SC 740-20 prevents this distortion by requiring that tax expense be allocated among the components that gave rise to it: continuing operations, other comprehensive income, discontinued operations, and items charged directly to equity. Each component is then presented net of its own tax effect, giving readers a true after-tax picture of each piece of the business. The allocation of tax to continuing operations is calculated last, not first. Under a SC 740-2045, You first determine the tax effects attributable to all other components, OCI items, discontinued operations, equity transactions. The tax assigned to continuing operations is whatever remains, total tax expense minus the amounts already allocated elsewhere. This residual approach is intentional. Applying a flat effective tax rate to each component separately is a common and consequential error. It ignores the interaction effects between components and can produce allocations that do not add up correctly. The sequential allocation method exists specifically to avoid that problem. When a component of the business meets the criteria for discontinued operations under a SC 200-520, its results are removed from the continuing operations section and presented as a single net of tax line near the bottom of the income statement. The tax effect allocated to discontinued operations is not included in the income tax expense line for continuing operations. However, readers still need visibility into the pre-tax income and the tax charge separately, so a SC 700-4020 requires disclosure of the tax effect in the notes. This two-layer approach, net on the face, gross in the notes, gives readers both the clean summary and the underlying detail. Other comprehensive income items each carry their own tax effect. Unrealized gains and losses on available-for-sale securities, cumulative translation adjustments, and pension remeasurement adjustments are all presented net of tax, either with the gross amount netted down or with a separate tax line within the OCI section. Certain tax effects never touch the income statement at all. Excess tax benefits or deficiencies from stock-based compensation under a SC 718 are recorded directly to additional paid-in capital. Tax effects of treasury stock transactions also go to equity, and when a prior period error is corrected, its tax effect flows with the error to the retained earnings adjustment. A negative effective tax rate is not always a red flag, but it always requires explanation. It arises when a company records a tax benefit despite having pre-tax income, or records tax expense despite a pre-tax loss. The causes are real and legitimate: large tax credits, non-taxable income, release of valuation allowances, or discrete items like settlements of uncertain tax positions. The problem is not having a negative ETR. The problem is failing to understand why it occurred. Every unexpected ETR result must be investigated and documented before the financial statements are issued. Auditors and regulators will ask, and the answer needs to be ready. Let us close with the essentials. Income tax expense is made up of current and deferred components, but only one line appears on the income statement face. The breakdown belongs in the notes. Intraperiod tax allocation under a SC 700-4020 ensures that each component of income and equity absorbs the tax it generated, preventing distortion of any single line item. The tax allocated to continuing operations is always the residual, calculated after all other components have been assigned their share. And whenever you see an effective tax rate that looks unusual, that is not the end of the analysis. It is the beginning. Thank you for completing this section on income tax expense and intraperiod tax allocation.